Hi guys, we've been talking a lot about misconceptions and mistakes that people make when they go out into the property world with money and finance and trying to go down that pathway. And mistake number 4 today is not reading the small print. Now, you've often heard or may have heard that finance is the glue that holds it all together. Well, many people don't ever go and read their documentation when they sign off on mortgages and loans when they first go out there. Now, I'm not a massively detailed person, but I certainly took the advice from a friend of mine to say, go and get your agreements checked out, and I paid a solicitor to go through that agreement to find out that pretty much any mortgage you sign, the banks have all the control. You have no choice. If you want to change anything, they basically just say on your bike. So a couple of clauses you need to be very aware of. There's one called the All Monies Clause. The All Monies Clause very much relates to your securities and your debt facilities and your assets, meaning that if you have a house and if you then basically have used equity from that house to then buy another property, and we've talked about this in a previous mistake, the banks will cross-securitize you. Now, the All Monies Clause basically states that they can go and draw money from any of your facilities across your position. So meaning that if you had an investment property that you had an issue with and you couldn't pay the mortgage because your facilities are set up together with that one lender, they can go and take your house. So you need to understand the All Monies Clause. Some banks structure it a little bit differently or have it worded differently, so you can have them stand alone, but most will cross-securitize your own position. There's another clause, and I don't know what the clause is called, but what it basically says is if you have all your accounts with one bank, they need not but can draw funds from any of your accounts based on your change of your circumstances. So in other words, if you had a personal account with $20,000 on it, you had your savings in, and you had a business account in a separate one where you had funds in, and if for any reason you got behind on repayments, whether that's an investment in shares or crypto or a line of credit, or you've just run out of funds and cash flow for your business and overdraft, they can, but need not, have you give them the option to go and take funds from anywhere when you sign, which means they could go and take all your savings and use it to prop up any other facility they deem fit based on their rules and their small print. So guys, read the small print, and if you don't, at least have someone go through it so you're aware of those things, and you can and at least ask the questions to the specialist you're using to make sure you understand what risk you have. Of course, this same principle applies to property contracts, and having a good conveyancer, a good legal person who can go through that with you is really important, because they basically change from state to state, and also your special clauses need to be right, because if you ever get stuck, you need to be able to have the option to get out of that deal before you're fully committed to go forward and have a way to get out. Anyway, I hope that makes sense. Reading the details is pretty important, and asking the right questions. Take it easy.